Good morning. You are watching a daily market outlook for Friday, 27th of April 2012, the end of the week, and the last day brings additional pressures in the market as news that came during the night are rather disappointing, mainly for Eurozone, as already announced. The S&P downgrades Spain and calls for Eurozone action. Further points of the overnight session that Bank of Japan ups bonds buying 10 trillion yen and extends duration from the immediate result of the downgrade was of the S&P's downgrade of Spain, was affecting the Asian shares that edged higher, and the single currency came under pressure. Stronger dollar during the overnight session pushed the commodities lower, as the crude oil is losing ground of yesterday's gains above 104 level. Now it's trading below 104, and the gold is sliding off its yesterday's highs above 1660, currently moving at 1650 zone. More significant is pressure on the single currency that is has lost already some significant supports and currently heading towards a break point at 131.50. More details about the recent events, as Standard & Poor cut its credit rating on Spain by 2 notches, citing expectations that government finances will deteriorate even more than previously, though as a result of contracting economy and an ailing banking sector. The rating agency, which downgraded Spain to triple B plus from A, also put a negative outlook on the credit and said Spain's situation could deteriorate further unless ambitious measures were taken at European level. The S&P said in the statement they think risks are rising to fiscal performance and flexibility and to the sovereign debt burden, particularly in the light of increased contingent liabilities that could materialize on the government's balance sheet. Moody's Investor Service rates Spain as A3 with negative outlook, and Fitch ratings at A, also with a negative outlook. It was the first downgrade for Spain since new Prime Minister Mariano Rajoy took office in December. A spokesman for Spain's economy ministry said the S&P move did not properly reflect the impact that reforms announced by the government would have on reactivating an economy which has now entered its second recession in 3 years. From Bank of Japan, that had its rate announcement earlier this morning, is facing a mounting government pressure, eased the monetary policy further on today's meeting by boosting asset purchases by 10 trillion yen, approximately 124 billion US dollars, more than markets had expected, and pledging to buy longer-term government bonds in a show of resolve to pull the economy out of deflation. But in what might serve to cool expectations of further aggressive easing, the central bank has said consumer inflation might approach its 1% target as early as in 2014, as the world's third largest economy shifts towards recovery. The central bank surprised the markets by boosting government bond purchases under its asset buying scheme by 10 trillion yen, doubled the usual amount, and increased buying of riskier assets, exchange traded funds, and real estate linked funds. From the other side, the U.S. economy shows again signals of weakness, as the economy growth likely cooled modestly in the first quarter, as replenishing of investors by businesses slowed, though stronger demand for automobiles and a lift to home building from warm weather, blunted the blow. Gross domestic product is expected to have expanded at 2.5% annual rate according to the polls. That would be a moderation from the fourth quarter's 3% pace, but decidedly stronger than economists' prediction early in the quarter for growth below the 1.5% level. In some ways, today's report on GDP should stack up well when compared with data from the fourth quarter. In the final 3 months of last year, inventory building accounted for nearly 2/3 of the economy's growth in the first quarter. Demand from businesses and consumers is expected to have taken up the slack. A brief look at today's calendar to see the latest releases and those that are due to come. As mentioned, Japan stayed the same rate with increasing the bond buying, while Japanese housing starting that was released at early hours of today came at 5%, a disappointing figure compared to 8.1% forecast and the previous release of February at 7.5. Also the rather negative, lower than expected release was on German import prices for March that came at 0.7% compared to February's 1% and today's forecast at 0.9%. Swiss economic barometer that was released at 7 o'clock GMT came in better than expected. 0.26 was forecast for today. It came 0.4%, also above the previous month release at 0.08%. The key releases of today are US GDP data. As said, quarterly GDP is forecasted at 2.5% compared to 3% of the previous fourth quarter of 2011, while advanced GDP price index is expected to go by 2% compared to 0.8% of the previous release, and employment cost index slight increase to 0.5% compared to 0.4% of the previous month. University of Michigan consumer sentiment for April is expected to slightly improve. 75.8 is forecast for today compared to 75.7. We're going to take a look now in the markets and see the latest movements that were caused mainly by Spanish downgrade and the Bank of Japan's action, starting with the single currency. As we can see, the pair on the hourly chart has lost ground after losing initial support at 132.20, 132.15, and then 132.00, and final base at 131.70 zone. So far, extension down to 131.57 was seen, ahead of significant support at 131.50. That is basically the break point, and the loss of 131.50 would likely signal temporary top at 132.62, fresh high posted yesterday, and allow for a deeper reversal from the short-term rally of 129.93 that peaked yesterday at 132.62. So far, we have seen the retracement of exactly 38.2%, with further easing down, looking for test of 131 static support and 130.96, 61.8 Fibonacci retracement, the loss of which would signal possible return down towards very strong support at 130 zone, and signal an end of a short-term pardon. And signal an end of a short-term recovery attempt of 129.93. Studies on 4-hour chart are still in the positive territory, but all pointing lower. That increases risk of further easing, while the situation on the daily chart is still rather in the sideways mode, but a loss of 55 days moving average opens way for test of the downside. Dynamic support 131.17 is 90 days moving average ahead of static support at 131.00. On the upside, immediate resistance is at 132, 132.11, while firm break above these levels is required to avoid immediate downside risk and refocus upside levels at 132.50 and 132.62. Cable holds its a strong uptrend of 158 zone. That was the recent base. 158.17 was the low of 16th of April, where the recent steady move started, with the high so far seen at 162.05. This high of yesterday, and this also marks a pardon. This also marks a fresh 7-month high. Currently, the pair is in the corrective mode with the 161.50 zone, where it's the 20 days exponential moving average on the 4-hour chart. So far, containing dips, and ideally reversal at this point would keep the immediate bullish structure in play for a possible further attempt higher. Still worrying is the bearish, MACD bearish divergence that still exists on the 4-hour chart, and sees potential and risk of further easing. A break above 162.05 would signal avert immediate downside risk and signal further extension higher, with the next target seen at 163.00 as strong psychological resistance, and 76.4% retracement of 167.45 to 152.33 at 163.88. On the downside, as said, 161.50 zone was tested so far, ahead of 161.43, 161.28.50 and 61.8% retracement levels, with break lower to weaken the structure. However, the main short-term support lies at 160.75 zone, which marks double bottom of 23rd and 25th of April, as well as 55 days exponential moving average on the 4-hour chart, and basically only break of this level would more significantly weaken the short-term structure and allow for a deeper reversal. For now, still a positive overall tone keeps the upside firmly in focus for the cable. The dollar-yen remains under pressure and continues to travel south, despite overnight's action after the Bank of Japan's release, when the pair spiked up to 81.43, but gains were short-lived as the main bear trend line of 84.08 capped again the upside attempts, and a quick reversal down towards overnight's low at 80.47 keeps the downside in focus. A negative structure on the lower time frames is maintaining the bearish tone, as well as daily chart that shows the bears firmly in play. The main support now lies at 80.28. This is the low of 16th of April 2012, a break of which to open way towards 50% retracement at 80.09, and the low of 28th of February at 80.00, ahead of 79.70 that marks 90 days moving average, and 79.52 post intervention peak of end of October 2011. Only break above 81.77 lower high of 20th of April would avert immediate downside risk and allow for further recovery. Until then, focus remains, so short-term focus remains on the downside with 80.28 coming as initial target. The dollar Swiss is in the near-term corrective mode after hitting a fresh low at 90.84. Basically, the break below initial supports at 90.90 and 90.84 has seen extension down to 90.56 so far, and current bounce higher sees potential of a stronger correction. However, the key barrier is currently at 91.70, high of 23rd of April, and as long as this level stays intact, the current bounce is seen as corrective. This morning's action higher briefly broke above the bear trend line of 92.08, high of 18th of April, and also took at 55 days exponential moving average at 91.22 out for now, but it seems that this is not going to be longer lasting move, as the overall picture is still pointing is the negative tone still dominating on dollar Swiss as a part of the larger picture, as the latest reversal of 92.50 still keeps the downside in focus. The recent low at 90.56 and the main bull trend line and triangle support at 90.50 zone are key supports for now, and the break below these levels to open a more significant 90.00 that remains as short-term focus for dollar Swiss, as the negative tone of 92.50 continues to drive the pair lower. As said, only break above 91.70, also close to a 61.8% retracement of the latest down leg would signal fresh strength and a possible revisit of levels at and above 92.00. Until then, most likely scenario would be a lower top and fresh extension lower, as long as said the 91.70 caps the upside. The gold is pulling off back off its yesterday's peak at 1660 as a part of the short-term recovery of 1623 double bottom that ran out of steam on approach to the main bear trend line at 1663 and also 61.8 Fibonacci retracement of the broader down move from 1686 down to 1623. The improvement on 4-hour studies seems to be running now, as the price action is moving lower. Immediate support on the downside is at 1650 zone, where it's 20 days and 55 days moving average, and the break below these levels would bring bears back firmly in play for possible extension down towards 1624 and more significant 1612 low. On the upside, we need to see the break above 1663 zone, firm break higher, and the retest of minimum 1686 in order to improve the broader negative picture, with the regain of 1700 zone, where we have a static resistance and the 200 days moving average required to improve the larger picture of gold and prevent further slide towards 1600 and 1522.32 double bottom. And last, we're going to take a look at crude oil. The recent recovery that peaked at 104.90 yesterday seems to be running out of steam, as the hourly studies are turning negative at this point, with the price attempting to break below initial support at 103.85, with 103.73 seen so far, with break below moving averages on the hourly chart, as well as break about below a short-term bull trend line of 101.82, now turning immediate focus lower with the 103.10 seen as the next static support. As long as the levels at 104.50 and 104.90 stay intact, there is a risk of further easing with the as shown on the 4 hours on the hourly chart. 103.72 marks exactly 38.2% retracement, with the 103.36 50% ahead of our main target at 103.10, and 61.8 at 103.00. On the 4-hour chart, the studies are still in the positive territory, but started to point lower, and that this might signal further easing. Only break above 104.90 and 105, where is the main bear trend line, would ease the current near-term bear pressure and open way for further recovery as a part of recovery from 167 10th of April 2012 low. That was all for today. We're back on Monday at 7:00 GMT. I wish you a nice day, successful trading, and nice and relaxing weekend. Good luck.